Even if you understand the basics of stock compensation and can find your way around your company's cap table, the rules that regulate equity compensation can be a little confusing. My name is Paul Vogt with PCE Investment Bankers, and today we're talking about one such rule, ASC-718, and what it means for your company's financial statements. ASC-718 is an accounting standard that requires that all equity compensation be accounted for at fair value on your company's financial statements. These equity awards are often a component of employee compensation, and ASC-718 provides guidance on how to account for these awards, when to measure fair value, and how to expense it. It's important that equity compensation is accounted for correctly because shareholders, investors, and even banks want to make sure that your financial statements are accurate and that there's transparency to all those investors and banks and shareholders. This means that a company would have a third-party auditor come in and review the books and records of your company's financial statements. The actual calculation of the equity award can vary immensely, but the idea is to have a fair value determination that is booked on your company's financial statements. For example, if a company grants common stock to their employees, then we would want to understand what the value of that common stock is. Another equity award are stock options. Now, we would want to understand what the value of that stock option is. And some of those calculations can be a little bit more complex than just determining the fair value of the common stock. In addition to common stock that's been granted to employees or stock options, there are other types of equity awards, such as stock appreciation rights, incentive units. These can sometimes be more complex to value, and the vesting conditions of all these equity awards really dictate the methodology that goes in to determine the fair value. You need to consider what those market conditions are when you're determining the fair value of those equity instruments. If your company grants stock options or other equity awards that have market-based vesting conditions, then those market-based vesting conditions need to be incorporated into the fair value determination. And in order to achieve this, a more complex model is often required, such as a lattice model or a Monte Carlo model. So it's important to know not only the type of equity instrument that's been awarded, but also the vesting conditions around those equity awards. This will dictate not only the methodology utilized to determine the fair value, but it will also dictate how that equity instrument is expensed on your financial statements. Prior to your company contemplating any equity compensation for employees and even non-employees, it's very important to consult your auditors and your valuation expert to help you address the fair value determination and how to expense those awards on your financial statements. Thanks for joining me today. Please subscribe to our channel so that you're notified when new content is posted.